Hello and welcome to our first in the series where we talk to you about the commodity markets, the nitty-gritties, the explainers and the very basics. Well, starting with the commodities itself, it is a raw material. It is the primary product which is used in various factories, construction, manufacturing, etc. And commodities are of various types. The first one is the hard commodities. These are the natural resources that are mined or extracted. For example, gold, metal, crude, rubber are some of the commodities which are either extracted or they are mined. And then you have soft commodities. These are agriculture or livestock like wheat, soybean, orange juice, sugar. These are all commodities that come under the category of being soft commodities. When you talk about commodities, there's a marketplace for it where you are buying, selling and trading in many of these commodities. There are various types of markets as well. Spot markets, for example, are the markets where you make immediate payment and the delivery as well happens there and then. These are also known as physical or cash markets. And then there are future markets, which are standardized instruments which are traded on the exchange. These exchanges can be in the regions or they can be international or national exchanges as well. In these exchanges, the delivery happens in future in a date that is ahead. The major exchanges in the commodities are in US, in Shanghai and in India as well. In the US markets, the major exchanges are ICE, CME, CBOT and NYMEX. In Shanghai, you have Dalian Exchange and Shanghai Exchange. This is where markets take reference prices from. Within India, we have MCX. This is where you have non-agro commodities trading. NCDX is where the agro commodities trade. In the UK markets, all eyes are on London Metal Exchange. All global markets, global buyers, sellers look at LME if they are buying, dealing in metals of any case. And then Japan also has Tokyo Commodity Exchange. This is, by the way, the first market that opens in a day. This is where you get immediate reference pricing on market open in many of these commodities. Well, the question to ask is on how and why should you be trading in commodities or commodities derivatives? Well, this is an access for you to centralized and liquid marketplace. This is exactly the area where you can hedge in the future, whether you are into consumption or production of that commodity. Whether you are an investor, arbitrager or speculator, you can trade within these exchanges. Remember, these exchanges are regulated and the standardized commodity trading is only that happens here. They also are liquid and efficient markets here. The regulators are important and necessary, even mandatory, because they ensure that there is a limit, there is no market or price manipulation here, and that is how these markets are run quite smoothly. Well, the question that you mostly get asked is on whether commodities are a good investment. Well, as all investments, commodities also come with their own risks. The leverage trade that is used in reaping profits in commodity trade without owning them is a major positive that you can see in these commodities. Also, with the kind of scenario that we are in right now, where there are recessions, geopolitical tensions and inflations, commodities are seen as a hedge against all of these concerns, clearly giving you a lot of profit, minimizing your risk and a definite yes in your portfolio.